Hey folks, thanks for tuning in. We'll just wait for our CEO Knight to jump on board and for a few other people to join, and then we'll get started. Looks like Knight and the other hosts are here. Oh, here's Knight. Awesome. And so we'll just wait for our two other experts to jump on board, and then we'll get started. Good morning, Janine. Good morning, Amanda, Mary, Janine again, Rosie, Charmaine, lots of you. Good, awesome. It's going to be a great session. Hey, good morning. It looks like Sean's on board now too. Super. We'll just wait for Jordan to jump on board, and then we'll do some quick introductions and we'll just jump straight on in. There's Jordan. Fantastic. Good morning, Selena. Good morning, Vienna. Good morning, Trisha. Good morning, Mark. Awesome. Hey, Jordan, are you on board now?
Yes, just having an issue with my camera.
That's okay. All right, we'll get started. Good morning, everybody. Thanks for joining in. We're really privileged today to have two amazing experts on AML with us. I'm going to just do a few quick introductions and then I'll hand over to Knight and he will help facilitate our webinar. If you have any questions and you want to ask Jordan or Knight or Sean or even myself, just jump in and write your question on the right there. I'll be just moderating, so if you have questions or if there's any technical issues, let me know. My name's Lou and I'm the CMO here at Relab, and I'd like to introduce you to Knight Howe, who is the CEO and co-founder of Relab.
Hello everyone. Thank you very much for that wonderful intro, Lou. My name's Knight Howe. I'm the CEO and co-founder of Relab. And now I understand that we have a close to 200 audience today, guests. Thank you very much and welcome. For those of you who are not familiar with Relab, Relab is a business-to-business software solution for property professionals so that you can access all the property-related data in one place. And Relab was founded back in 2016, and we are a startup that's growing. Right now, we have over 12 staff. We're based here in Auckland, New Zealand. So now today's webinar's topic is all around how to mitigate risks around AML for property professionals, and we're very fortunate to have Jordan and Sean on board with us. So I think my role today is facilitator. Oh, there we go. Hi, Jordan.
Hey, Nat.
Cool.
Hey, Lou.
Hello. So why don't we get into it? And just a wee reminder for our guests who are watching this, if you have any questions, please feel free to send your questions through the chat channel and we'll record it down and we'll do a few, take a few questions throughout this journey. So let's get into it. Now, the first question I think I'm going to ask to both Jordan and Sean. Why is AML important, and how, what other areas of risk do you see around AML for different real estate professionals?
I can start with this one. So obviously, since the 1st of January 2019, it's become a legal requirement for both the residential sector in regards to sales, but also in regards to the commercial sector. It applies for sales and also leasing. So AML obligations are fairly broad. They don't just cover the CDD or the identification of vendors or the lessors, lessees, etc. There is a lot of documentation and training required, and that's where sort of Sean comes in his expertise in regards to assisting reporting entities with training their staff, establishing and maintaining their risk assessments and compliance programs. So that's usually the sort of first step of AML compliance, is taking care of all that fun administration paperwork side of things. So I think today probably the best way to structure the session would be for Sean to sort of kick off by talking about that sort of first setup phase for reporting entities to be compliant, and then also to take over talking about the nitty-gritty of the day-to-day operations of actually figuring out what type of CDD needs to be required depending on the structure of your customer.
Fantastic.
Yeah, thanks for that, Jordan. Hi guys, Sean here from Hawkins Consulting. one of the fundamental things of anti-money laundering is it puts an obligation on a business to not only understand what the risks are and as they impact your business specific to the way that you operate, but also to have controls in place to combat what those risks are. So what I've kind of looked at is I've looked at three different formal warnings that were given to reporting entities and kind of stripped it back to looking at what the core kind of reasons are as to perhaps why those warnings actually came to fruition. Now, the Department of Internal Affairs has released two formal warnings that we'll talk about. They have released more, but the ones that we're interested in are the two from Department of Internal Affairs. And the Financial Markets Authority has also issued a formal warning very recently to Sharesies. If you don't already know about it, we'll cover that a little bit as well. One of the first warnings was given to property brokers. Now, the three key takeaways from that was that property brokers had failed to hire and train compliance-based staff. So that is, the compliance officer didn't actually have an intricate understanding of what's going to face. And they also didn't have the remaining staff within the portfolio actually understanding the risks of the business as it relates to anti-money laundering. So training is quite a critical emergence in the space, and is an area that we see people falling over a lot in, is actually understanding those risk-based approaches and how your business can actually be impacted. The second reason was that they failed to maintain and in place risk assessment and compliance program. And again, this kind of shines through in all three of the warnings that we're looking at with property brokers, Kid Legal, and Sharesies, is that a lot of reporting entities might have in place a risk assessment and might have in place a compliance program, but it's the actual effectiveness and whether you have mechanisms to actually maintain and keep up to date those documents, right? So your risk assessment needs to be based on inherent risk. So that is making sure that your risk assessment addresses the risk that your business faces before there's any controls in place. And your compliance program needs to have adequate policies, procedures, controls, keep it current, keep it maintained, and make sure that it actually, in terms of the way that your business operates, it reflects that. Property brokers also didn't have enough mechanisms in place to monitor compliance and follow guidance documents released by the sector supervisors. So a lot of the guidance documents are things like the Identity Verification Code of Practice, which Jordan will talk about shortly, having regard to enhanced due diligence guidelines that are released by sector supervisors, and beneficial ownership guidelines as well. So those documents really lay out sort of the fundamentals of completing CDD and understanding what enhanced due diligence actually requires. The next warning by Department of Internal Affairs was to Kid Legal, which is an Auckland-based law firm. It has about 10 staff on board. Again, same with property brokers. They failed to maintain a compliance program, but it was also noted that they actually failed to develop the compliance program to the extent that it needed to meet the minimum requirements of the Act. Again, those maintenance functions of the compliance program are really, really critical and important. So looking at what kind of tools you actually need to monitor compliance with, but also keep it up to date. So for example, what processes do you have in place when you identify a consistent shortcoming in your business, and how do you actually mitigate those factors? Looking at things also like, do you have tools in place to monitor compliance on a monthly basis? And do you have a mechanism in place to do a mandatory 6-month or 12-month review? They also failed to show how staff would comply with what their compliance program actually had outlined in it, but also comply with the CDD requirements when solicitors and barristers were onboarding you or accepting new clients. And so that again comes down to staff training. So making sure that staff understand the risks, but also understand what the business needs to do to be. Sharesies, which was the most recent warning that came out from the Financial Markets Authority, that was quite a lot more detailed on what they actually gave to the public. Again, more consistent things was they actually grew quite fast without having regard to compliance mechanisms needed to be in place. So looking at the things more focused on core CDD requirements. So nature and purpose of the business relationship. So why do their clients want to actually use their service, and how are they going to be using that service? Failed to identify, I think it was 7,815 of their clients hadn't actually been properly identified as they needed to have been. And they also failed to determine when enhanced due diligence was actually required of them. So what are the minimum requirements that trigger that, and what are the risks in their businesses that actually trigger that as well? So three kind of consistent things occurring there is around staff training or lack thereof, maintenance of the compliance program and mechanisms in place to make sure that it actually stays up to date and stays current, and ID verification as well, and determining when enhanced due diligence is requirement. Those seem to be the key kind of themes that occur over those warnings. So what I'll just quickly run over now is just how what are the little things that help make a risk assessment and compliance program a good risk assessment and compliance program, right? Now, the first one with a risk assessment is to remember that you should always do your risk assessment based on inherent risk. So you've got two factors there: inherent risk and residual risk. So residual risk is the risk of the business once you've got policies, procedures, and controls in place to mitigate those risks. And inherent risk is the raw risk profile, but so before there's any controls in place. So it's quite hard when you're drafting your risk assessment to kind of identify a risk and then not directly underneath it put how you're going to fix that risk. That's what your compliance program is there for. If there are any natural sort of mitigating factors in a risk that you identify that your business naturally kind of fixes on its own, then that's fine to list in there. The sector supervisors provide a risk assessment guideline, quite easy to find if you Google AML risk assessment guideline. It's one of the first ones that pop up, and it's literally a step-by-step process. What factors you should be considering for your risk assessment. It goes through all the minimum requirements of the Act, and it actually gives you a breakdown of what they're looking for. So you're not just having to sort of look at the black letter of the law and sort of try and interpret it. It actually gives you sort of some questions and factors to consider. The next piece of advice I would say is to look at the sector risk assessment. So the sector risk assessments are updated once every 2 years, and basically the regulators for the respective sectors they supervise come together and they create a risk profile based on each of those minimum requirements set out in the Act, and give you quite a few good points, although it is only general, so you do need to kind of tailor them specifically to your business. So that can help you to sort of have a look and identify perhaps what you haven't actually thought about when developing your risk assessment. The last one is just to have regard to appropriate guidance material and make sure that you have a control in place to monitor compliance with your risk assessment and make sure that you keep it current. So whenever there's a change in your business, if you change the way you deliver your service, or if you add a service to your portfolio, then you need to make sure that you're completing an update of your risk assessment and making an assessment around whatever that development in your business is. We'll then just move on really quickly to the compliance program. So what makes a successful compliance program? So very similar, there's a compliance program guideline that the sector supervisors have released. Again, it's really helpful, goes through all of the minimum requirements that the Act asks you for, but it also goes through the definitions of policies, procedures, and controls so that you can actually identify what they are. And it goes through kind of on an expanded basis what each minimum requirement is asking you to do. So what factors you need to consider for staff training and how to have an effective staff training policy, how to make sure that you have effective staff vetting policies, making sure that you have effective CDD policies, not just copying and pasting the legislation into your policy, but actually laying out verbatim how you're going to actually achieve identifying your clients and understanding the nature and purpose of the business relationship. The next one is that your risk assessment should, your compliance program should be based on your risk assessment. So a lot of the things that we see is that a compliance program can kind of be quite general. And so when you look at a client's risk assessment and program, you would expect that the risks identified actually pull through to the compliance program. So for example, if your risk assessment identifies that you deal with high-risk countries quite often, or countries with insufficient AML controls in place, then in your compliance program, we would expect to see quite a lot more emphasis put on the country assessment portion of it. So how you'll actually make those assessments, and what circumstances enhanced due diligence applies, and in what circumstances you might actually decide not to do business with the customer because the risk is too high. So it is definitely about making sure that you haven't just got a generic kind of program, that it is actually addressing those specific risks that you've identified your business to have in relation to
Hey, Sean,
money laundering or financing of
do you mind
terrorism.
if I quickly jump in there? That's awesome. Hey,
Yeah, not a
just
problem.
to quickly recap, before coming to this meeting, I actually had a very basic understanding of AML, but I think you put it very succinctly in terms of those good practices. And I love analogies, and I think to me a good analogy is like being a safe driver on the road, right? Number one, with a light safety start, so it's like very always keep a good car. And number two, decide what road you're going to travel on. You're going to travel on the asphalt highway, you're going to travel on the gravel road. That's kind of the central risk assessment. Number three is compliance process, keeping up to date, licensing up to date, make sure you're driving to the conditions, and always sort of check the road and the license as well. Is like making sure your risk assessment is aligned with the compliance process. Okay, I think I might have confused something here. Does that make sense?
Yeah, sorry, I don't think we could hear you very well for some reason.
Note, I think your sound is a little bit patchy, but I think we've got most
Just
of
why
what
don't you carry on? Let me
yeah.
have a look at my sound setting.
No, that's all good. Yeah, look, the last kind of things just to go over is just making sure that you have controls to maintain those policy documents. So that was kind of the key thing that shined through in those warnings, right? So just making sure that in your program you consider things like, is it appropriate to put a monthly compliance report in place, and assessing or doing random checks on clients that signed up, looking at things like, have staff been trained on time, have they been vetted on time, and do random spot checks on your clients as well. So you can do that kind of on a 6-monthly basis. If you've had 100 clients sign up for your services, or you've done 100 transactions, perhaps you check a certain percentage of those and just go through and recreate the CDD process based on your compliance program. As long as you have that audit trail, and as long as you have something documented that can show that you've been doing those checks, and that process is outlined in your compliance program, then you'll tick the box for maintaining your compliance program. So those are my tips for your policy documents. So I'll hand it over.
Okay. Test 1 2. Test 1 2. Awesome. Apologies. Yeah, I
It's
had some
much
sort of
better.
issue
Thanks,
in mind.
Mike.
Hey,
Yes,
thank
yeah.
you very much, Sean, for that high-level overview on the importance of AML and how should professionals go about analyzing the risk and keeping their compliance process up to date. Now I'm going to pass on to Jordan, who's the CEO and co-founder of Real AML, who's doing some awesome work in the technology space, helping customers with their AML needs. Over to you, Jordan.
I just wanted to check if anyone had any questions for Sean. If not, we could sort of leave it to the end, but I just want to make sure if anyone had any sort of pressing questions, they can jump in now. Otherwise, I'll take over. Okay, so as Knight mentioned, I'm one of the co-founders of Real AML. We're a really tech-focused AML firm focused on electronic identification biometrics across 23 countries. We also provide outsourced AML and work with a lot of independent consultants such as Sean Hawkins at Hawkins Consulting. So I'll start today by going over the Identity Verification Code of Practice 2013 and just having a general discussion about the 3 parts of IVCOP 2013 on how you can actually identify your clients. I'll then talk about the 2017 explanatory note and the recent 2021 explanatory note. So I understand that the majority of the attendees today are in the real estate industry. However, obviously what Sean and I are discussing does apply to all sectors. For phase 2 and phase 2 reporting entities. So when you're captured by the AML legislation, obviously you need to look at what type of entity you're going to be dealing with. So most commonly, it would be an individual. And as a general rule of thumb, I'm going to make the assumption that most reporting entities attending today would be classified in sort of low to medium risk. So therefore, if you're onboarding an individual, standard C2D would apply. You'd then look at sort of limited partnerships or partnerships. Similarly, standard C2D. Sean briefly covered trusts. So trusts would trigger enhanced due diligence. Companies most commonly would be standard C2D, but it's really important to look at the structure of that company. So a few things to look out for when you're looking at a company. If you've got, purely individuals, and let's say simple structure could be just 2 directors and 2 equal shareholders. Therefore, standard C2D would apply and you would just identify those individuals. However, if there was a shared allocation of a shareholding that it was greater than 25%, similarly, or if you saw that there was a corporate trustee, then you would need to investigate further whether there was a trust involved in the company structure. The other entities we commonly see are charitable trusts, and they also trigger enhanced CDD. So back to IVCOP 2013, it's broken up into 3 parts. Part 1 is documentary identity verification, and that's most commonly face-to-face. So that's when you're meeting your customer in person, you're citing, say, the bare minimum, their passport and a utility bill. You're taking a copy of those, you're time-stamping them, and you're storing them, okay? So that's the most common sort of scenario for part 1. Under part 2, it's document certification. So that's usually non-face-to-face or remote. And that's where your customer would get the same combination of documents in part 1, say, most commonly a passport and a utility bill, certified by a referee, okay? The DIA in the IVCOP doesn't specify explicitly about how you can receive those documents, although in the DIA's FAQ, they do state that it is best practice to actually receive the original copies of those documents. We see this a lot, that people are accepting certified copies via email. And as I mentioned, whilst it isn't explicit that that's right or wrong, it is definitely best practice not to do that, because the DIA states that there is the possibility of those documents being tampered with, in that sort of process, okay? Another thing to note is that those documents need to be certified within the preceding 3 months of you receiving those documents. And I couldn't tell you how many times I see certified documents being accepted that were certified, 1 or 2 years ago. And that just certainly doesn't sort of cut the mustard. Okay, so that's part 2. And then part 3, we've got electronic identity verification, or EIV. Okay, and I'm really happy with the recent explanatory note on electronic identity verification, because it actually gets into the nitty-gritty. It actually names data sources that you can use, and it talks about the different components of what actually makes up an electronic identity verification. So at the bare minimum, an EIV, or an electronic identity verification, needs to verify your customer's name and date of birth from one independent reliable data source, and their name and address from another or a second independent and reliable data source. One thing that we do find, and we see a lot, is people get a little bit sort of confused, rightfully so, when they transition, say, from part 1. So, a perfect example is, during these lockdowns. Some firms, perhaps prior to lockdown, meet their customers face to face. That's just not possible right now. So, what we find is that, when they transition to part 3, they still think that they need to obtain the same combination of documents. So, for example, they think that they still need to, collect, say, a passport and utility bill, and then verify those documents electronically. We've had direct confirmation from the DIA, which was our sort of interpretation from day one, is that you don't actually need to cite originals or copies of your customer's identity documents when you're actually running an electronic identity check. It's a data-driven process where you're verifying their credentials. In saying that, the recent explanatory note that came out this year did really sort of reiterate that confirming their identity information via electronic sources is just one half of the process. Okay, the other half of the process is actually matching the person you're dealing with remotely to the identity that they're claiming to be. And I always like to use the example of, if you lost your wallet, if somebody found that wallet, could they pose as you, right? Could they do business with a real estate agency by doing an electronic check? If you're not implementing some kind of mechanism to link them to their claimed identity, they would pass as you. The DA has given some guidance in their 2017 explanatory note, talking about some examples of different measures that are required. So, I think probably one of the simplest outside of biometrics that we've gotten confirmation from the DIA would be, let's say, for example, your customer works at Deloitte. Okay, you go to the Deloitte website, you can see in the staff profile, you can see their mobile number and their email address. Okay, so you've verified, say, their mobile from an independent, reliable source, being the Deloitte website. You then contact them on that website, on that number from the website, to make sure that the person you are identifying is that particular person. However, we do think that obviously biometrics is a much more robust way of doing so. So in the recent explanatory note, they give some really detailed examples, and I'll post the link in here for everyone to have a look at that. So they also sort of cover some of the sort of faux pas that a lot of people are making out there, I guess, when they're trying to implement a mechanism to link their customer to their claimed identity. So we've seen that in the past, clients may use an EID tool, they verify their client's identity, and then they may ask their customer to send them, say, a selfie of them holding up an ID document. They may jump on a Zoom call and ask them to do the same thing. In the recent explanatory note, the DA said that is not a compliant method of doing so. Biometrics is an automated process. So they give an example, which I'm just bringing up now, which talks about all the different steps that they sort of go through. And do note that in this explanatory note, they are doing a little bit of self-promotion, as the DA does, talking about that they expect that the first data source will be, say, the DIA or NZTA for driver license or passport. But that's certainly not mandatory. And we've received direct confirmation from the DIA that it's not mandatory when you're running an electronic identity check to actually use a government data source. So they can be commercial. So, for example, the credit bureaus would be the most common commercial data source that's used. But in one of the sort of examples they give, they talk about that you verify the customer's sort of name and date of birth from 2 different data sources. You then capture an image of the passport. You then capture an image of the person that you're dealing with using a robust sort of liveness detection system. Then facial recognition software then extracts the photo from, say, the passport and then compares it to that liveness test to make sure that they are the same people. Additional checks are mentioned, such as sort of, that no tampering has occurred with sort of passport, that you also validate what they call the machine readable zone, or the MRZ data on the passport. So you can see there are sort of a number of different steps when you are running an EIV check outside of just verifying that client's identity. But some very key points are that you do not need to cite identity documents. You don't need to hold copies of them, whether or originals, when you're actually conducting an electronic identity check. That being said, it can assist with the sort of broader requirements. And furthermore, it's not mandatory to use a government data source. Because as we know, there's a lot of people residing in New Zealand that may not have a driver license or a New Zealand passport. And so it would be, excluding them from being identified and doing business with them electronically if that was the case.
Point. Jordan, we've got a couple of questions here. You don't mind me just jumping in quickly. What do we do with clients onboarded retrospectively, say in the last year? Do we have to go back to them and do a biometric check?
My opinion on that would be yes. I've seen different opinions from auditors. Some auditors would come in and ask them to remediate everything, retrospectively. Others would say moving forward, you should do X, Y, and Z. We do have a standalone tool called Facematch, which can be used, and we actually launched that tool specifically for that use case, where reporting entities may have just run an electronic identity check in the past, but hadn't actually linked that customer to their claimed identity. So we provide a standalone tool to actually match that person or match your customer to their claimed identity. The Facematch standalone tool isn't an end-to-end identity tool. It's to be used in conjunction with either an existing identity check or a sort of current EIV check. So I hope that answers your question, Yash.
There's also a comment here about perhaps just mentioning about the financial risk of non-compliance and what that would be.
Yeah, Sean, do you want to cover that one?
Yeah, it's a good comment from Greg here. The penalties are quite severe for non-compliance with the Act, and before the regulators tend to go straight to a sort of financial penalty. They'll normally the first step is normally they'll sort of issue you a private warning followed by a public warning, and then if you continue to not comply, they'll then move on to the pecuniary warning. So that has given you the actual fine. So in terms of sole traders, the fines can be, or individual compliance officers, there's a civil liability component built into the legislation. So compliance officers, where they're negligent for the responsibilities, is up to $300,000 in fines, or 2 years imprisonment. So there's either civil or criminal penalty there. And body corporates can be anywhere between 2 to 5 million in fines, and there have been prosecutions. The regulators are not afraid to jump into that basket if they need to, and it can have very devastating consequences for the business. In fact, I think all of the businesses that have received fines are no longer operational, because that's effectively what they're designed to do, is to either make you get it right, or make sure that you don't find yourself in that line of business anymore. So they are quite severe penalties, but just remembering that they don't go straight to those financial penalties. They do sort of normally go through a process. So if you issued a warning or you get a warning shot from the regulator, adhere to what they're asking you to do.
I think it's also worth mentioning is the reputational risk and damage. That certainly has a monetary factor to it as well. So that's my sort of understanding as well, is that these warning shots that the DA and FMA send out there to some firms could be, more costly than an actual monetary penalty based on that sort of reputational risk. Okay, so one other thing I wanted to cover was in regards to sort of outsourced checks. So Section 34 of the Act says that reporting entities can certainly use an agent to conduct a part, if not all, of their CDD obligations. One thing that we have received confirmation, and we see a lot, is that there are outsourced firms out there that basically just provide a one-page sort of summary, sort of pertaining to that the CDD has been completed. And we've received confirmation from the DA that a piece of paper purporting to be issued from a third-party provider stating that CDD has been done isn't compliant. Reporting entities need to actually hold copies of all the EIV reports, or either the original certified copies or whatnot, trust deeds, source of wealth of funds, etc. Okay. So just be mindful of that, you know, a piece of paper just stating that something has been done isn't sufficient, because the buck stops with the reporting entity, not with the agent. So whatever reports you're receiving from, you know, an identity provider or an agent, reporting entities still need to review that to make sure that they're comfortable with it. You can't just solely rely on the third party for your AML obligations. Another thing I wanted to sort of just touch back on is, again, is the enhanced CDD, so on trusts. A lot of people, and Sean and I discussed this recently, a lot of people just try and avoid you know, asking the question to a customer if, you know, there's a trust involved with, you know, a company structure or just the transaction at all. One thing that you need to note is that you don't actually need to obtain a copy of the trust deed when you're doing enhanced CDD on a trust. You just need to actually obtain the information that pertains to that trust deed. So for example, who are the settlers, appointers, who are the trustees, who are the beneficiaries? So we deal with a lot of lawyers and accountants, you know, across the country. And one thing that's becoming increasingly common, which is understandable, because you know, some people don't want to you know, expose all the information pertaining to the trustee. Whereas we found that lawyers can actually sort of provide, you know, a summary just outlining that information without actually having to provide the trustee. So if you ever get pushback from a customer that doesn't want to actually provide a trustee, just ask if they're comfortable with their lawyer or accountant providing a summary of the information provided in that. It obviously is a bit different when it comes to source of wealth of funds, that we can provide a list of documentation that is generally sort of accepted there. I can see another couple of questions coming through. So Yash has asked a question: when we do an EIV and assuming it's a pass, are we required to store a copy? No, that's not the requirement. So as I mentioned earlier, we've received direct confirmation from the DA that it's not mandatory requirement to cite identity documents when you're compliant with Part 3 of IVCOP, which is EIV, or electronic identity verification. So yes, to answer your question, you don't need to actually store copies of their ID or utility bills. That's applicable for Part 1 or Part 2. Okay, I can see Tracy's asked, sometimes it's difficult to do a pass result on an EO report, depending on who the client's name is recorded on various databases and their situation. Using two failed reports. Well, so when you say about using two failed reports, I'm assuming you're talking about maybe perhaps using two partially passed reports. So for example, to achieve a complete pass, you need to verify, say, name and date of birth from one data source, name and address from another. I think perhaps how I'm interpreting this question is, if you had two partial passes, could they be a combined pass? And the answer to that would be yes. We would, yeah, okay, yeah, that's great. Yeah, so yes, I would certainly give my advice and opinion that yes, two partial passes combined, as long as one of the partial passes was name and date of birth and one of the other partial passes was name and address, that the combination of the two would be sufficient. But on top of that, as long as there was also a politically exposed persons check. That's probably, and I'm sure Sean could agree, and most auditors out there would agree, that it's probably one of the most common areas of non-compliance in regards to day-to-day CDD, is people either getting their customer to self-verify whether they're a PEP, or a reporting entity saying, well, I've known this customer for 20 years, I know they're not a PEP. So the PEP check in itself is broader than just that individual, because it does cover what's called also an RCA. So an RCA is a relative or close associate. So for example, someone could be a PEP by proxy. So if their spouse, sibling, etc., is in a politically exposed position, then they would most possibly also show up as an RCA. And we also do, sanctions, adverse media checks, and also what they call SIP, special interest persons, which are usually people who are terrorists. So it does cover more than just that individual when it comes to the PEP check. So that's pretty much all I'll sort of cover today. We only, have sort of an hour, 45 minutes. So
one more question.
I'm sure we could probably talk all day on AML. I can see another question. Yeah, so Adriana, in that situation, and that's fairly common, you know, some people may just administer the trust themselves, and it could be fairly simple, and it could be a vehicle that's used 20 years ago just to sort of purchase a property. In that situation, we most commonly would ask for a sale and purchase agreement. Because that way, you know, if you've got an S&P in the name of the trust, you can see what they bought it for. If you could also possibly obtain any loan documentation, you could easily determine what the value is of the property today, what they bought it for, any outstanding loans, etc., and that would give you an indicative sort of source of wealth.
They bought it 20 years ago.
So I hope that answers the question there. Surely there'd be an S&P. S&Ps were still around 20 years ago. But again, you know, and Sean, correct me if I'm wrong, but you know, in your sort of compliance program, there are exceptions. So there's always going to be exceptions.
Yeah, there's always going to be exceptions. And I think it's just important to remember that a trust that holds a family home is, for the most part, probably a family trust, right? And so there's different classes of trust. You've kind of got your family trust and then everything else, almost like your discretionary trusts. Family trusts are always going to be on the lower risk scale because it is mum and dad who are the settlers and the trustees, and it's for the benefit of the family. So in that instance, you know, where there is only a family home, no accountant, no solicitor, assuming that you can get some form of paper trail together, a sale and purchase agreement, some loan documentation, even in the absence of that, some bank statements showing source of funds and source of wealth, then that would pass for me if I was auditing that particular client, knowing that so long as I understand that assets that trust as a vehicle to hold are for the purposes that is outlined in a trust deed, and that is normally a family trust.
To cover just before we ask for final questions.
No, I can't think of anything else. No, just happy to answer any questions that anybody might have around policies or any technical questions.
Oh, from Tracy, yeah, I can see that. Yeah, so with the PEP checks, we use an internationally recognized search tool that covers, you know, 40 plus different watch lists across 200 countries. And that's updated on a daily basis. So that's how it would verify what we call sort of RCAs, SIPs, and PEPs. On the PEPs quickly as well, it is quite common that you get what's called a potential match or a false positive. So please don't get alarmed. I know that when people start doing PEP checks for the first time, which they should have been doing for a few years now, but anywho, they do get quite alarmed when they see a potential match. You have to understand a lot of people share the same name in the world, so therefore that can trigger a potential PEP match. But there's a lot of different ways you can discount the potential PEPs. You can look at the country where they reside, you can look at the date of birth, you can look at variations in the name. In our PEP reports, it usually includes a link with a photo of that person as well. So if you've met the person, you know what they look like, or you've got a copy of, you know, a biometric face match or a copy of an ID, you can then cross-reference that to the image in the potential match on the PEP report.
Just a question there from Kerry. I struggle with source of wealth, or with the source of wealth aspect when they say the deposit comes from savings. How far back do we need to see in this statement as the threshold? Yeah, so that kind of comes down to making sure that your program outlines the types of documents that you would ask for in the first instance. So that would be the place that you refer to. So you would go to your compliance program and you would say, what are the acceptable documents that I can get to determine where the source of funds have come from? As a general rule of thumb, although very dependent on how your business operates, how your compliance officer operates, and what your program says, you should be collecting, if they've got sort of a long span of savings, so say, for example, it was an accumulation of funds over the past 10 years, it would be very uneconomical to get 10 years worth of bank statements, sift through them and see all the transactions. What you'd be wanting to look for is some samples. So perhaps a couple of bank statements from when they first started putting money into their savings account, maybe partway through and then maybe towards the end. That combined with things like maybe summary of earnings statements from the IRD, or even if they have an accountant or a lawyer who's already done source of funds and source of wealth, a letter from them outlining where it's come from as well can be a substitute to some of that information. So there's combinations of things that you can get to obtain it and to take reasonable steps to verify it.
And Carrie-Anne mentioned about they should be getting an accountant involved. Well, yeah, obviously we all know that.
Yes, so we'll just take this one final question from Yash. Is it fair to assume we jump into enhanced CDD if a PEP check comes back as a fail?
Yeah, so with the PEP checks, Yash, they with our PEP checks anyway, they'll come back as either a pass being a no match, or they'll come back as a potential match. So you really need to go through those steps that I just mentioned to determine whether it's a false positive or whether they're a true PEP. And if they do happen to be a true PEP, which is actually very rare, out of hundreds of thousands of PEP checks, I think I can count on one hand how many have actually been legitimate PEPs.
Oh, fantastic.
But if they are a legitimate
well, gosh,
PEP, yes,
I've certainly learned a thing or two. Jordan and Sean, thank you so much for your time. That was pretty amazing. There's a lot to digest there. We will be sending out just a wrap-up email in about an hour from now, which will have the details of both Sean and Jordan on there and how to get hold of them. A lot of you already know Jordan from Real AML, obviously. So, Knight, I'll just hand over to you to wrap up the session.
Absolutely. Thanks very much again to Sean and Jordan for your awesome insights on AML. Again, if you're interested to find out about Real AML, jump on their website, give it a go, or get in touch with Sean or Jordan. If you're a real estate professional and wanting to learn more about Relab, feel free to jump on www.relab.nz. We offer free trials, or get in touch with Boo or myself if you have any questions. Stay safe.
You're welcome.
Thank you.
Thanks, Knight. Thanks, Lou. And thanks everyone for attending. Cheers. Bye. And thanks, Rachel Button.